Thank you for joining us today. We hope that after watching this presentation, you've seen how we delivered strong results and how we continue to high-grade our portfolio. Today, Sinead and I will be answering your questions. And now, please, could we have just one or two questions each so that everyone gets the opportunity? And with that, could we have the first one, please, Dan?
The first caller is Ron Buiso from Reuters.
Hi both. Thank you very much. I have two questions. You announced a 4 billion buyback today and another 2 billion in dividends, and that's around 40% of your Q1 free cash flow. So that's significantly above the 20 to 30 rate you've previously guided. Why is that? And does that mean that we should expect a change in that ratio at the upcoming CMD? Well, that was kind of two adjacent questions. One more question I want to ask is about the valuation gap with the US, and if and why you are worried about that gap. Is it because of risk of a takeover bid? And what can Shell do about it? Thank you.
Ron, good morning, and thank you for the question. I'm going to direct the first question to you, Sinead, and I'll take the second question.
Certainly, and good morning, Ron, and thank you, as Wael said. So the first question, you're specifically talking about, indeed, the compelling returns that we have offered shareholders and investors this quarter. So as you say, it was 4 billion on a buyback and 2 billion with respect to dividends, all on the back of some incredibly strong operational performance. As we've taken through before, we have a 4% progressive dividend, you're aware of that. But in terms of the percentage, in terms of the distributions, we look at a frame with respect to 20 to 30% coming through in terms of our CFFO, so not our free cash flow, but our CFFO. In terms of that, how do we look at it? What's our thought process behind that? So Ron, where we go from that is that we can't take it in isolation. We have to have quite a pragmatic approach. It can't be just about one quarter. So if you remember, last quarter, we had actually very high CFFO of some 21 billion, and this quarter we're sitting at 14 billion. And of course, last quarter was linked very strongly towards the fact that we had some significant working capital inflows as well. So when you look at it across both quarters, in terms of both the operational performance and also the macro, it gives us confidence to be able to distribute the 4 billion that we did this quarter. Indeed, it is over the 30%, and we've been over that given the macro that we're seeing at the moment. So you're seeing greater than 35% at the moment. In terms of what does that mean, it's simply about what we see at the moment, and of course, any updates would come in CMD as you suggest.
Thanks, Sinead. And Ron, to your point around the valuation gap, firstly, just let me acknowledge, indeed, we do see a significant undervaluation in the Shell share, and we are working hard as a management team to be able to plug that gap. We have a lot of focus areas at the moment. We are trying hard to be able to continue to drive strong focus on performance, and you see a lot of that actually coming through in the first quarter results. Actually, excellent performance across our asset base and giving us encouraging signs that we're on the right track. We're also very focused on discipline and trying to make sure that we are allocating capital in a responsible way to be able to achieve the sorts of returns that our shareholders expect of us while we implement our strategy of both delivering the energy that the world needs today, as well as building out the low-carbon energy future that the world also needs from us. And so we think we're doing that in a balanced way. Why does the undervaluation concern me? Of course, our shareholders, essentially our owners, have invested in this company and I think deserve to be able to see a valuation that is commensurate with what the capability, the cash flow delivery that you have seen out of this company over the past few quarters, and Q1 is no exception. So that is what really sort of we focus on, and I look forward to being able to do one quarter after the next to be able to build that trust and the confidence in our investor group in the new management team here at Shell. Thank you, Ron. Can we have the next question, please, operator?
The next question is from Jenny Strasberg at Wall Street Journal. Please go ahead.
Hi, good morning. Thank you. I'm curious if you can describe what you're seeing in terms of the China reopening as what you attribute to the demand you're seeing and the margins on lubricants and others. And also, can you describe your latest thinking about the levers you're taking into account as you look at calibrating plans for production and guidance you'll provide in June, please? Thank you.
Okay. I'll start off with China, and then if you want to say something, Sinead, about the June production. On China reopening, Jenny, firstly, good morning to you. And I think it's fair to say that we have seen a good recovery in China, but it's not yet back to where it was pre-COVID. And so on the oil side, for example, we're getting close to 2019 levels of demand. On the gas side, we have seen a strong rebound, in particular in the services sectors, a bit less so in the industrial sectors. And that, of course, is driven more by the demand for exports coming out of China. And that's been softened by the fact that the broader world's markets are a bit more volatile at the moment. What we're seeing as well, and you'll see that coming through our results, is that from a lubricants perspective, the demand has been strong. That has helped lift our marketing results this quarter, helped by the Chinese market recovery, and to some extent, of course, lower base oil prices, the key feedstock that goes into lubricants. So by and large, I would say good progress that we see in China. It's slightly mixed when we go beyond China. And of course, there's quite a bit of, I think, market jitters at the moment, given some of the credit restrictions that we are seeing as a result of the central banks fighting to prevent the continued inflationary pressure, and of course to prevent a contagion of some of the banking issues we've seen in the States. So I think China is a bright spot right now for us on the demand side. Do you want to talk about CMD?
Thank you, and thanks, Jenny. Indeed, so you're talking specifically about production. I think it's fair to say that with any management team coming in, you look on what you build on from the past and what you're going to take forward, and that's what we will bring very specifically in Capital Markets Day. So any new guidance would come there. I would say, of course, that from an upstream perspective, we're incredibly proud of the performance that has occurred. And what you have seen of our upstream is in terms of both hitting all of their different targets. They've been delivering very, very strongly, 2.8 billion of earnings this quarter. But also beyond that, what we see is that they have, over the years, managed to focus on value rather than volume. And that's very important to us. And hence you've seen us make moves over the years to have certain divestments, including this quarter as well, such as ERA, which was a Californian asset, and also, of course, in Malaysia, where we had a divestment of 2 assets, which were non-core. So we will continue to do that in terms of our oil business. But in terms of production, we'll give you more guidance at Capital Markets Day.
Thanks, Sinead, and thank you, Jenny, for the question. Operator, if we can have the next question, please.
The next question is from Will Mathis at Bloomberg. Please go ahead.
Hey, good morning. Thanks for taking my question. I wonder if you could talk a bit about trading. It's been really important for earnings, but it's not something that is disclosed. So it's often hard to predict what it's going to be, how it's going to contribute to earnings. Do you see that as an issue for getting your investors to be able to properly value the business compared to peers that don't have such a strong trading business? And how are you planning to manage that?
Well, thank you for the question. Sinead, do you want to take that?
Certainly. No, thank you, Will. And it's such an interesting one because the way I think about it is actually about optimization rather than about trading. So if you think about it, I don't think there's any surprise that what you see is a lot of conversation about who are the biggest traders out there. And what you see is some of the independent trading houses are looking to buy assets. What they're looking to do there, of course, is be able to have exactly what we have the sustainable ability to deliver value into the future. So what we do is we optimize around our assets. And there's 2 great examples of that you'll see, particularly this quarter. Our integrated gas business, where in particular, we're very much focused on the Northern Hemisphere, the winter in the Northern Hemisphere. And what you see is a lot of length. So our assets are producing in those quarters to ensure that we can deliver when it's much needed in the Northern Hemisphere, particularly in Europe. Of course, then we push our maintenance towards Q2 and Q3. And you can see that slide 7 is a really good one to have a look at in our pack as well. In the same way as we mentioned earlier, that with respect to our chemicals and products, who had a great quarter as well, what you saw this quarter was a view from them at looking at what's happening on refining. What they did very well there in terms of the business was to say they would delay Norco's turnaround to later in the year safely and with a lot of thought behind it to be able to produce as high as they could during the period where refinery margins were strong and where there were some of our competitors taking down refineries, particularly in the US. Now, that's what I call optimization rather than trading. Of course, there is some trading that goes as well with it, but that just gives you a bit of a feel. So I am not worried about the ability for our shareholders or investors to be able to value it, because they should have confidence in the underlying portfolio that we have. Thank you.
Thanks, Sinead, and thank you for the question, Will. Operator, if we can have the next question, please.
The next question is from Emily Gosden at The Times. Please go ahead.
Morning, thanks very much. First question, just about your trading division again. Could you just give a little bit more explanation about why it performs so well? And when you make profits on trading oil and gas and optimizing oil and gas to supply to the UK and Europe, I don't believe that trading division is subject to a windfall tax. So what is the tax rate that you pay on those trading profits, please? And secondly, I'd be grateful if you could update us on Shell Energy Retail, when you expect the sales process to complete. And obviously, you do carry out wholesale trading for other retail suppliers in the UK, some of which are bidding to buy Shell Energy Retail. So is that an appealing kind of area of the business for you to carry on growing? And would you consider selling to somebody who would still be reliant on Shell for energy trading? Thanks.
Emily, thank you for the two questions. I'll start with the Searle update, and then I'll come back to you on the trading one, Sinead. So in Shell Energy Retail, so our home energy division here in the UK, I think just to correct Emily, what we're doing at the moment is going through a review, just to provide some context. So we invested in this a few years ago as we try to pivot towards home energy and seeing how we can synergize, back to your point around wholesale supplies, synergize across the entire value chain to be able to provide our customers with reliable energy. We have continued to do that. However, the markets have been very, very challenging. There's been significant intervention by the government to be able to support that market. But on balance, what we have found is it is just not the sort of area where we can potentially outcompete others. And so what we are doing at the moment is conducting a review and looking at all options. Everything's being considered. And I hope to be able to have an update on that in the coming weeks as we conclude on our decision of what to do next. On the wholesale front, we see the two as separate. We continue to supply many of those customers who need to be able to have a reliable supplier and a creditworthy supplier of energy, of electricity. And that's something which, of course, we do here, but also in other places around the world, like in the US. And so something that we will continue to look into. Sinead.
Certainly. No, and thanks, Emily. Indeed, in terms of why are our results so good, it is a mixture of a number of different factors. So indeed, I think I explained just in terms of how we manage to optimize around the assets we have. And of course, one of the key points there, Emily, is the fact that we actually operated incredibly well this quarter. You heard us refer to it earlier. So the operational performance across all of our sectors was strong this quarter. That, of course, allows you to have volumes, which allows you to be able to optimize around those, as I've described. In terms of your comment, you asked specifically about whether certain things are part of windfall tax and what the effective tax rate is and all of those aspects. We deliver products and volumes all over the world. We pay the tax in the country that we are asked to pay the tax in, so we pay the prevailing tax rate that is there. So there's not one answer on that. It, of course, goes across all of the different areas. I would say that our effective tax rate across the globe for this quarter was 34%. Hope that helps.
Thanks, Sinead. And Emily, thank you for the question. Dan, can we have the next question, please?
The next question is from Tom Wilson at the Financial Times. Please go ahead.
First question on buybacks. I mean, as Rod mentioned in his question, you're above the buyback rate, which you kind of committed to. I wondered whether you feel any pressure to maintain the 4 billion buybacks now quarter on quarter. You will have seen that BP pared back its buyback slightly, and despite beating expectations, then took an 8% hit on its share price. So I'm kind of wondering whether you kind of create a rod for your own back, and whether kind of coming into this quarter in particular, you considered buying back fewer shares, but then basically realised you have to keep it at 4 billion because that's now what shareholders expect. And then secondly, another question on trading. You might have seen yesterday, myself and others covered a research note put out by Bernstein where their analysts estimated that trading contributed 16.6 billion in EBITDA last year, about 20% of group EBITDA. Is that a fair estimation? Are those figures accurate in your view? Thank you.
Thank you for those questions, Tom. I'll quickly address the TNS one and the trading one, and ask Sinead if you want to go for the buybacks one. We won't disclose, Tom, as you know, what the share of trading is, because I think, to be clear again, we see the fundamental business model that we have is all about investing in assets that allow us to be able to have these positions and then taking a number of positions with our customers. We've talked often about the size of our customer base. We think we have a truly advantaged customer base, over 1 million B2B customers. We're one of the largest players in that space. And of course, we have production in multiple different energy sources and in different locations around the world. Our ability to pull that together, and we of course use financial instruments to be able to minimize the risk that we take when we do that, just means that the inherent business model is one about predominantly optimization. And so I do think I would not want to be in a position to, again, try to break down exactly what was because of this asset or that asset. But rest assured that trading, and more importantly, optimization in general, play a critical role in our business model today for the conventional energy, but I think will play an even bigger role going forward as we look at new energies, as we look to synergize, for example, hydrogen, equity hydrogen production, green hydrogen production from our facilities with hydrogen production from others, and try to supply that to the customer, leveraging the significant pipeline capacity we have, the terminals, and the contacts that we have with many of our customers. And so that business model of continuing to optimize is a core part of what Shell is and will continue to be. Sinead.
Indeed, and thanks, Tom. I did see the article, yes, indeed. Whilst I may not agree necessarily with all the numbers from the Bernstein report, I did read through it, as you say. I think we've described that very well on the trading side. On the share buybacks perspective, do I feel pressure for the 4 billion? As we said, what it's really about, Tom, is just making sure that we don't look at it in isolation, because you can't. So if you go back to the quarter before, we were over 21 billion in terms of CFFO. So if you were to look at that in isolation on that quarter, given the frame that we've given, which is 20 to 30% of the CFFO, you would say, should we have paid out more, yes or no? If you look at it this quarter with the 14 billion, so we look at it in the aggregate together. Hence the fact you will see 8 billion of share buybacks in the first half of this year, given the macro and given our performance as well. The frame that we've given is very clear. It is around the fact that it is a hard floor and a soft ceiling. And that's what you're seeing. Given where we are today, yes, we are over that soft ceiling. And you're right that it is over 35% of distributions at this point in time. But no, there is no run rate, there is no specific. It is about, in the moment, looking at the frame that we have and looking at macro and the performance. And that comes together in our decision making. Thank you.
Thanks, Sinead, and thanks again, Tom. Dan, if we can have the next question, please.
The next question is from Bert van Dijk at Dutch Financial Daily. Please go ahead.
Yes, sir. Good morning, you all. I've got a question about the margin development. I was wondering if you could shed some more details about that. The product margins were higher, as well as the chemical margins, but the refinery margins were lower. But I would assume that lower crude feeding into the refineries would result in higher margins. So maybe you could explain a little bit more about the margin developments of the different products you produce. Thanks.
Thank you for the question, Bert. Let me take that one. So I think on refining margins, firstly. So you're right to say we saw a drop in refining margins, Q4 to Q1. I think Q4 they were around $19 a barrel. In Q1 it was closer to $15 a barrel on the back of our indicative refining margin that we disclose. There's a few things happening there. I think one is because of what has been a robust refining margin environment, a lot of capacity that typically would have come offline has not yet come offline. That is also meeting a significant wave of new capacity that's coming into the market. So this year we anticipate around 1.3 million barrels per day of new crude distillation unit capacity to come onto the market. So you have that combination of what is already quite some significant length, with the reality on the demand side that OECD countries in particular are not necessarily growing their demand given the broader economic context. And that is putting some pressure on those refining margins. And actually, since the first quarter, we've seen that pressure even grow coming into the month of April. And that's been, I think, margins have halved from where they were just a month ago. And so that is playing out in the market. On the chemical side, the opposite has happened in terms of the trajectory of the margins. We've seen that go up from $40 to $140 a ton. And that's partly because indeed utility prices have come down, a core component of the overall margin environment there. But once again, the $140 a ton is still below what is typical historical average, closer to 200 or so. And so that also puts weakness on the chemical margins. By and large, what I would say is for a company like Shell, because we have a diversified portfolio, our ability to be able to be resilient to various volatile markets, whether it's refining, chemical, oil, gas, means that we can consistently be able to assure our shareholders that we are resilient through both the down cycles and, of course, we can enjoy some of the upside of the up cycles. Bert, I hope that gives you some perspectives there. Dan, if we can have the next question, please.
The next question is from John Mannering at Argus Media. Please go ahead.
Thanks for taking my questions. You're sticking to the 23 billion to 27 billion Capex range you've had for some time now. So can you explain why this is enough for a major energy company like Shell to be spending, given the energy trilemma challenges of energy security and affordability that are likely to remain major issues this decade, alongside the sustainability challenge, of course? And also, I wanted to ask you a question about this stake you have, and I think operator status as well, in the Green Energy Oman hydrogen project. How is this going, and what is the timing? What would be the milestones of this project? Thank you very much.
John, thank you for those two questions. And you want to start off with the first one?
Sure, indeed. And I think it's a great question, John. As you go through the whole conversation as a management team, it's about, indeed, where do you allocate your resources, and whether that's people or whether it's capital as well. And that's one of the big discussions that we have. Our range of 23 to 27 billion, we believe, will serve us well for the opportunities that we have and what we see we wish to proceed with. So last year we sat at around about 25 billion, you may be aware. That's how we ended the year, but we're within the same range again. And what we look at is, as we go through, we're looking at where should we allocate the capital according to the returns profile. So indeed, that energy trilemma comes in because specifically we also look at it from a carbon footprint as well. We feel very comfortable that we will be able to invest appropriately with appropriate returns within that 23 to 27 billion across our sectors, and ensuring that we also cover the inorganic acquisitions that will come in. So, for example, what you've seen is, you've seen some aspects like Nature Energy as an acquisition that came through, or Volta, which we also discussed, which came through in Q1. That 23 to 27 billion of guidance will cover that in its entirety.
Thank you for that, Sinead. John, you asked a question about Geo in Oman. Just to provide some context, so we fundamentally believe that Shell is well positioned to be able to support governments as they think about developing clean hydrogen, whether that's green or blue hydrogen. We have, in essence, the largest project going on at the moment in Rotterdam, in the Netherlands, to the tune of 200 megawatts of green hydrogen capacity that's going to come from offshore wind into an electrolyzer in Rotterdam to produce green hydrogen for our own uses, and hopefully one day for customers who are willing to offtake some of that green hydrogen. On the back of that, and on the back of our very strong relationships in Oman and the incumbency that we have had there, we have been in discussions with the parties in Geo, the project around a green hydrogen development facility. I'm excited about that because I think it is really an opportunity to be able to create both supply for domestic purposes as well as potentially one day for export purposes. Oman is blessed with fantastic renewable conditions on the solar side, but even on the wind side. And so the milestones would see us first go into the development of that renewable energy in the plot space that we are agreeing with the government to be able to build on. Thereafter, and of course all pending the economics of these developments, we would then look to invest in electrolyzers to be able to build up the capacity for green hydrogen production. I won't give you dates. Ultimately, this is very much the pace at which the government and the partners choose to go, and it's going to depend on the pace at which the markets evolve to be able to offtake some of that green hydrogen. Ultimately, this has to be an economic opportunity as we exercise capital discipline and capital focus, but we're very excited by the prospects that it brings. Thank you for that, John. Dan, if we can go to the next question, please.
The next question is from Huub Giesbers at ANP. Please go ahead.
Hi, yeah, thank you. I have a question about a report by the, actually from Russian media, by the newspaper Kommersant. It said in early April that Russian authorities gave permission of a payment to Shell by Novatec for its previous share in Sakhalin 2. So I was wondering, because it wasn't really clear to me, did Shell actually receive this money or not? Maybe you could give an answer on that.
Yeah, please go ahead.
Certainly. Indeed. No, thank you, Huub. Much appreciate the question. I think it is very fair to say that we have acted with conviction in terms of our rapid exit from Russia. In terms of that, we've already exited our downstream business, we've exited the oil side of things, and of course, as you're aware, Sakhalin has moved over to the Russian side of things, the Russian counterpart. Where we are on that one is we've reserved our rights legally in terms of that. I am aware of the article that you're referring to. All I can say is that no payment has been made and that we are reserving our legal rights. Thank you for the question.
Thank you, Huub. And can we have the next question, please?
The next question is from Thomas Daly at Energy and Intelligence. Please go ahead.
Hi, good morning, Wael and Sinead. I have a question about Singapore and your decision not to proceed with the base oil and biofuel projects there. So does this mean that the Bukom refinery, or the Energy and Chemicals Park Singapore, as it's called, is no longer strategic for you going forward? Does it no longer fit your portfolio? And especially after buying the feedstock supplier Eco Oils last year, do you no longer think Southeast Asia is the right place to do biofuels, maybe? Thank you.
Tom, thank you for that question. I think indeed, just for everyone's context, so Bukom and Jurong are the refining and the chemicals units that we have in Singapore. We've been exploring different opportunities there, including the ones that Tom mentioned around both a base oil unit as well as a biofuels unit. You're right, Tom, we chose not to proceed with those projects, but that has very little to do with the strategic context of Bukom and much more to do with the fact that those individual projects were not economic in their own right. So we worked very closely with the support of the Singaporean government to see how we can make the economics work. But ultimately, we need to be able to be disciplined in the way we allocate our capital. So despite trying to make this economic, the market simply had not moved. That is different, of course, than what we have seen in the Netherlands, where we have invested in a biofuels facility. More because of the fact that the fundamentals work there, given some of the regulatory support that brings that project into the money and allows us to be able to achieve a double-digit return, so that we can reward our shareholders to make that investment. So that's where it is. I won't make any comments on Bukom or beyond that, but just to say that we continue to be committed to biofuels. Of course, we continue to be committed to base oils in our portfolio as a core part of our lubricants, our globally leading lubricants business. But we will be very selective in where we make those investments to ensure that we steward our shareholder capital accordingly. Thank you for that, Tom. Dan, can we go for the next question, please?
The next question is from Andrew Dykes at Energy Voice. Please go ahead.
Good morning. Thanks for taking my question. I just had questions around some North Sea projects. The first being if you could shed any light on a sail away date for the Penguins FPSO from Haugesund towards its North Sea station in the UK. And the second was on Cambo. I think this time last year you said it didn't make sense to allocate money there. In December you were still kind of looking at your options, so it would be good to know, where you're sitting on the Cambo project. Thanks.
Yeah, thank you for that, Andrew. Do you want to take those?
Sure, happy to. Indeed, Andrew, North Sea is, of course, one where you've seen plenty of action coming through, whether it's the Jackdaw FID. Of course, you mentioned Penguins, and of course, great to see Pierce up and running after its refit, bringing double the volumes that it was doing before, and particularly gas in at the moment when it's most needed across the UK. So very pleasing on that. In terms of the sail away of Penguins, as you know, it's gone up to the yard. It's going through those checks at the moment. I don't actually have a date for you at the moment in terms of the sail away. Still more work to do on that. And in terms of Cambo, I would say the same stands. It is not, from our perspective, economic at this point in time, and therefore we are not at this moment proceeding. So I hope that helps.
Thank you, Sinead. Thank you, Andrew. Can we go for the next question, please, Dan?
The next question is from Ashley Armstrong at The Sun. Please go ahead.
Hi, morning. I just wanted to ask, obviously, your bumper profits and share buyback has inflamed the debate about windfall tax and whether it's being taxed highly enough. I wanted to ask about that because surely the argument that if you're taxed more, there'll be a reduced investment is slightly weaker if actually you're directing most of that money towards shareholders now.
Thank you for the question. Did you have? Sorry, Ashley, I wasn't sure if you had the second one, or is that it? Okay.
Well, the second one was, I guess, are you concerned if there is a Labour government coming in? We're coming up to an election kind of next year, and obviously Rachel Reeves has already been speaking this morning about an increase in windfall tax.
Very clear. Thank you, Ashley. Let me take the second one, and then I'll let you have the first one, Sinead. On government, I think important to recognize when we make the investments in the energy sector, typically the break-evens are within, or payback periods as we call them, are within 10 plus years. And so what you experience is actually 2 to 3 administrations from the time that you make a decision to invest to the time that you actually see a payback. And so in all the countries in which we operate, we actually depend heavily on the fundamental institutions that are in place that protect the rights of investors. And we work with governments all around the world. And what we have seen, as we have seen in the UK for many decades in which we have operated, governments rightly have to do what they need to do. But I think governments are also conscious of the important role that companies like ours play in investing in the fundamental infrastructure in the countries. And so I think we have a lot that we can continue to offer the UK. As Sinead mentioned, there's projects we are producing today. We also bring in LNG volumes to be able to supplement the needs of the UK at the moment. We are a big investor in many of the low carbon and zero carbon opportunities here, potentially up to 5 gigawatts in offshore in Scotland, offshore wind. We're looking at CCS projects. So companies like ours are a big part of how we can potentially help the world decarbonize with the right ecosystem to be able to do that. And I would hope any government coming in would see that and support that. You want to talk about taxes?
Yeah, certainly. No, indeed. Thanks, Ashley, on that. And, I would always start, of course, is that tax is a matter for government. And we will, of course, pay whatever taxes we have to in any specific country. So I would start with that, first of all. On that front, last year globally, remember, we paid more than 13 billion in terms of tax. And actually this quarter we've had, in terms of tax paid, more than 3 billion as well. Actually tax charges of some 5 billion. But in terms of what we do, we play our part in whichever country we're going to be in, and we do it in a number of different ways. Some of that is around jobs, some of that's around investment, and some of that, of course, is taxes as well. So in terms of that, the investments, as you can see, Wael has talked about the range of different things we do within the UK in particular. But I would say, if you look at what we've been doing, we've invested over 10 billion or around 10 billion in the upstream alone over the last decade. And during that, that's despite only recently beginning to get into profit side of things. So we are investing very heavily there. Of course, the other thing that we're doing is making sure that we play our part in terms of decommissioning and making sure some of those older assets are cleaned up appropriately, etc. as well. And you can see that as well with more than 300 million expected to be spent this year in terms of decommissioning for the North Sea. So you'll see us spend more than $1 billion in upstream around that mark and some 300 million of decommissioning as well.
Excellent. Thanks, Sinead. Ashley, thank you for the question. Dan, can we have the next question, please?
The next question is from Graham Hiscott at Daily Mirror. Please go ahead.
Yes, good morning both, and thanks for your time. It sort of follows up actually on from that last question, but more specifically on reaction to the scale of the profits announced today. Lots of criticism. I mean, some calling it obscene, others saying that the company is profiteering off of, these are their words, off of the high energy prices, which have left so many people in fuel poverty in this country and doubtless elsewhere. What would you say specifically to those that accuse the company of, as I say, making obscene profits and profiteering? And then also, just on a factual point, Sinead, I think you slightly touched on this, but for this quarter, how much did Shell pay in energy under the energy profit levy in the UK?
Great, thank you for that. Did you want to take the second question quickly first?
Yeah, certainly. So we don't tend to disclose the specifics country by country, as you know, on that, Graham, as well. And on the energy profit levy, of course, I'm sure you're aware that actually it's set in terms of payments over a different period of time. So it's actually not through one quarter, and it's very heavily weighted towards the end of the year. In terms of that, we expect, as I've said in last quarter as well, we're expecting to pay more than 500 million in terms of the energy profit levy over the year. And we expect our tax charge in the UK to be over 1 billion. So I hope that helps.
And Graham, to your question around the claims by some of Shell profiteering, I think firstly, let me start by maybe just acknowledging that these are difficult times, right? Since the Russian invasion of Ukraine, we have seen food prices significantly increase. We have seen energy prices increase, even though they've come off a bit lately. But all of that has had a massive impact on government coffers, as well as, of course, on households. So we continue to try to do our part, and I described some of the things we are doing in the UK to make sure that energy is being delivered, to make sure that that folks are able to actually use the energy that they need. And particularly, I think our import of LNG into the country has been a big factor in ensuring that through the past winter, we haven't had the outages that some parts of the world have actually experienced as a result of what's going on. When it comes to the role that we play, I think, in this space, I do believe that we have a fundamental role to continue to invest in the supply of energy. The issue right now is one of lack of supply, which is creating these high prices. I think collectively as a world, we are under-investing in energy, whether that's conventional energy, where we are investing where we are under-investing collectively to the tune of $100 to $200 billion a year, as well as under-investing in low-carbon energy to the tune of trillions of dollars a year. And that's for various reasons. That's because of inflationary pressure, supply chain, inability to be able to generate returns that will attract some of that capital. And so what we continue to do as Shell is we are applying ourselves as much as we can to be able to develop the research and technology that hopefully will support in this space. We're making investments. I talked about, for example, in renewables. We're making investments in green hydrogen. We're making investments in carbon capture and sequestration. And so our role is to make sure that we continue to invest in the supply that the world needs, so that we have plentiful supply that hopefully will alleviate the real challenges that many are experiencing, whether it's at the pump or in their households. I hope that helps, Graham. Dan, the next question, please.
The next question is from August Graham at PA. Please go ahead.
Hey, I think you touched on this a little bit just then, but I was wondering if you could expand. It's early days still, I know, but if you could maybe speak a little bit about how you expect next winter to go. I mean, in terms of energy security in Europe.
Thanks, August. I'll take that one. It's a very difficult question because we simply don't know where things will go. Right? There's multiple factors. But let me maybe just reflect on the past winter and then play out to the next winter. In the past winter, what the governments in Europe in particular, I think, have done really well is they have moved into action to import and store significant gas to be able to avoid the worst of the winter months. We were helped, and we were helped by two key elements. One was a milder winter, not something that we should bank on because who knows where the next winter is going to go. But also we were hugely helped by the fact that under the zero COVID policy that China had implemented, a lot of the volumes that was destined to go to China ended up in Europe. Roughly 50% of the European LNG that came here last year actually was destined to go to China. And so that has created relief going into this past winter. And thankfully, it was overall benign. Where are we at the moment? Actually, storage levels continue to be healthy for gas. And so we see at the moment gas storage in Europe at around 55%, which is high compared to historical averages around this time of the year. So that's good news. The next question is, how quickly will China's recovery come over the coming months, and how much will China draw on that LNG around the world? How cold is the winter going to be? And then how will Russia respond? Because, of course, Russian LNG has continued unabated over the past year. If any of these goes negatively, that could create strains on the overall system. We will continue to do our part, to continue to store gas, to continue to produce gas, to continue to invest in new gas facilities to make sure that we support in the coming winter. I hope, August, that gives you a good sense of where things might be going. Dan, if I can go to the next question, please.
The next question is from Shadia Nasrallah at Reuters. Please go ahead.
Hi, good morning, and thanks for taking my question. I was wondering if you could talk a little bit about how you're thinking about owning renewable power infrastructure, given a lot of focus on sort of greener molecules that feed into greener fuels, as opposed to a kind of focus on producing green electrons. Do you actually want to own more renewable infrastructure, and can you give us a kind of flavor maybe of how much you might want to own in capacity versus what you want to trade? And then the second question, how do you see inflation in different sectors? Do you feel that is a big factor, and if so, where? Thank you.
Thank you, Shadia. I'll take the first one, and then if you want to take the inflation one. Capital Markets Day is around the corner, so next month hopefully we'll be able to update you on some of our thinking in the renewable space, but more broadly, of course, the various businesses in Shell. I think suffice it to say that we already have a significant renewables presence. So we have just north of 2 gigawatts of operated capacity, and we have a funnel that's just under 50 gigawatts of capacity. So there is a significant amount of renewable generation that is under Shell's ownership, or Shell is party to. Last year, we made a significant acquisition in India, a company called Spring, that is a strong platform for us to be able to continue to grow there. And we also made an acquisition the year before that of Savion in the US. Just two examples that we have. And of course, in Europe, in particular in the Netherlands, we have quite a big presence in offshore wind. We do feel that it's important to be able to have access to equity green electrons. But we also recognize that we are actually much more differentiated in our trading because of the synergies we can create between gas and power trading, because of the fact that we have been leaders in gas and power trading in Europe and in the US for a long time. And so this isn't is it this or that? It is much more of a thoughtful process around what do we want to do per country? What's the appropriate exposure? How can we get access to the electrons? And our focus is on making sure that we can deliver the premium returns that our customers would expect of any capital that we would deploy. Let me pause there and see.
Indeed, and thank you, Shadia. Inflation is always very much on our minds. What we have seen, of course, is a very different story in this first quarter than we would have seen towards the end of last year. So what we're seeing is a lot of that is coming off now. So at the time, I would have said, if you'd asked me this question probably last quarter, I would have said we're seeing it across all of the different areas, all of the sectors are coming through on it. And we were seeing on average sort of 10 to 15%. And we still see that across the sectors, but we're certainly seeing it come down. A company like ours has the benefit of course, having a fantastic supply chain organisation where we're very much focused in terms of doing standard agreements across the period. So we lock in with different suppliers, certain offtake arrangements, certain standard agreements, and that allows us to be able to have a bit more stability than many do across not just quarters but years, and therefore see less of that volatility or fluctuations coming in. So what are we seeing? 10 to 15% still there, but not so much hitting us. In particular, you asked about where do we see specific aspects. Steel is still very high, and of course rigs are as well. We have a great fleet of rigs available to us, which are locked in, so that doesn't hit us as much. And as I discussed before, we have key contracts in place around steel. Hope that helps.
Thanks, Sinead, and let me echo your recognition of our supply chain organization that I think has been doing really well under difficult circumstances over the past couple of years. Thank you for that question, and if we can go to the next question, please.
The next question is from Javier Blas at Bloomberg. Please go ahead.
Thank you so much, and thank you for taking an extra question from our side. A couple of questions, if I may. One on just general on the company's valuation, while and I'm very mindful that it's only a few weeks for the Capital Markets Day in New York, but I have been in listening to similar calls to this one for several years on Shell, and it's a recurrent theme of the CEO and CFO to promise shareholders that they are going to close that valuation gap with Exxon and Chevron and others, and nothing really happens after that. The valuation gap remains, and as a valuation gap that has remained wide open for multiple quarters already. So can you tell me what kind of confidence could you give to investors that really this time is different, that Shell has a new formula that will close that valuation gap? And related to that question, I think that one of the internal thinkings on the company is that there is a liquidity gap. I mean, obviously, the New York market is more liquid, and American companies are benefiting on that. I think one of your rivals made a comment that one of the reasons for the difference on valuation on the companies was the fact that the European companies are listed in Europe and the Americans are listed in New York. On that, have you thought about moving the main primary listing of Shell into the US? And if the answer is no, or we are not considering this actively, why not? What is the argument against moving into New York and relocating the headquarters? You did already from The Hague to London, from London to, I don't know, just Houston or somewhat even nicer in the US.
Javier, thank you. Houston's not a bad place, but let me try to address those. So the undervaluation gap that you talk about, I think firstly, just a reminder, of course, it was just 2019 when Shell and Exxon were neck and neck from a valuation perspective, so it wasn't that long ago. And of course, what we have seen over the past 3-4 years is that gulf between US and Europeans grow. And I think suffice it to say on your second question, this is not on my priority list at the moment. We've just moved to the UK. We're focused on making sure that we actually unlock the significant undervaluation through multiple levers which are directly under our control and which we can very quickly be able to get to, and I'll talk about that in a second. I think on your question around the undervaluation in general and why is it different this time, I think firstly it would be silly of me to claim suddenly everything's going to change one way or the other. All I can say is we are focused on a few things. We are focused on making sure that we deliver the sorts of returns that our shareholders expect of us. We have said, and we are acting, I think, with urgency and with pace to make sure that we continue to high grade the performance of the company. And Q1 is just one quarter. We see encouraging signs, but we need to be able to stick at it. We also want to be able to continue to be disciplined in the way we allocate capital. And again, we are making moves that hopefully our shareholders see are positive moves. Ultimately, my focus and my recognition is this management team, Sinead, myself, and our executive committee need to be able to build trust with our shareholders. We are new in these roles, and therefore we don't yet have a track record. I hope our track record will speak for itself positively, but that's something which we are very conscious of and one that we recognize we need to earn. And so I hope quarter after quarter we will earn that right to be able to see the valuation of Shell continue to improve. It's a company that has a strong balance sheet. It's a company that has 3 world-leading businesses in upstream integrated gas, in marketing. We have outstanding capabilities in trading and supply. And I think we have a strategy that's compelling and that's differentiated compared to many of our peers, able to not only survive today but thrive in today's environment, as you're seeing, while at the same time really building a portfolio that's going to be resilient into the future and create real value out of the shift towards zero and low carbon energy. So I'm excited, and I hope our shareholders can see that. But Javier, I'll thank you for that last question, and I'll thank all of you for your questions and for joining the call. We wish everyone a pleasant end of the week and hope that you can join us at our Capital Markets Day 2023 next month in New York. Thank you, everyone.